I get comments all the time in social media of, why am I so abrasive and why am I such an why do I not care about people making mistakes? And it's not that I don't care. It's that I choose to be brutally honest about problems that are obvious to me as somebody with experience in life and in training. Because honestly, the stock market doesn't care, but I can. I'm capable of caring enough to tell you a hard truth about what's going on in the market. Hello, everybody. My name's True Demon, and I'm the Devil's Stockbroker. Today, I wanted to try and do something a little bit different than my usual videos because one of the things that I have learned, having come out of one of the biggest bull markets in history, followed up by one of the worst bear markets, is that one of the most difficult skills to hone in learning how to trade in the stock market is maintaining a healthy mindset. One of the things that I struggled with during this entire foray into learning how to trade the market so religiously and so regimented was that it takes a severe toll on your psyche and your mental well-being if you're not prepared for the stress of it. So if you're here for some technical analysis, don't worry, I'll still provide some towards the end of this video, just to give you my thoughts on where the market is heading after a very interesting week. But the main focus is going to be on kind of recentering ourselves and figuring out a little bit more about what it takes to have a trader's mindset. And if you couldn't tell by the thumbnail of this video when you clicked on it, I imagine that you're wondering what in the hell could he possibly want to talk about that's a healthy mindset after something like that. What I'm going to talk to you about is the subject of brutal honesty, also called radical candor. One of the most painful lessons that you can learn as a trader is that the market really does not care how you feel. It doesn't care about your feelings. It doesn't care about what your bank account looks like. It doesn't care that you have mouths to feed or that you're not going to be able to make ends meet at the end of the week. The market doesn't care. It is a emotionless machine that is used for trading goods and dollars back and forth between two entities. That is it. It's a very neutral and emotionless mechanism. And learning how to trade in this market requires you to be a bit emotionless and machine like yourself. But we're not, we're humans. So, one of the things that we have to adopt as traders is being brutally honest with ourselves about whether or not we can actually do it. And I believe firmly that the reason why 98% of traders fail and lose everything as soon as they end up in the market and walk away forever is because brutal honesty and radical candor with yourself is extremely difficult. It's actually one of the things that is the hardest to master for the human mind. Being able to tell yourself what you can and cannot do, or being judgmental and harsh with yourself to the degree that is necessary in order to succeed in the market, it's hard. Our minds are naturally resistant to it. Brutal honesty is being able to be honest and say something that is a hard truth with the added benefit of empathy because you actually do care. And you may see this out walking around in the world when somebody tells a friend that something that is just open and honest with them, even if it's hard to hear, like somebody who has a drinking problem. If you're going to get somebody to stop drinking or to live their life in a healthy way, you have to be honest and acknowledge the problem. But the reasons why you do it is because you care. You actually give a damn about that person. Being brutally honest with yourself requires something different because you have to be your own source of counsel and also your own comfort. So that's something that we as humans really struggle with. Most of the time, we can only do one of the other or neither at the same time. On one hand, you might care about yourself deeply, but you don't. But you're not able to be honest with yourself about your limitations or your mindset, and that just leads to you being um, empathetic with yourself, but to a toxic level where you don't change anything, and you just live in ignorance and you justify yourself all the time. And if you're cruel to yourself with no empathy, that just does nothing but destroy your self esteem. You start talking yourself down, you're unnecessarily aggressive towards yourself, and it leads to defensiveness where you again begin to justify your actions and you just throw your hands up and give up eventually. And if you have neither of those things, neither care nor honesty, then you're just manipulating yourself and no change will occur at all. So to be radically honest, to be brutally honest with yourself is ultimately the path to successful trading and a lot of other things in life as well. I had my first real brush with this when I came to the sullen conclusion that I had lost a vast sum of money in the stock market. My first true massive loss came when I lost $20,000 in a single trade, and this began a ruinous descent that and ultimately ended up with me losing more than six figures in the stock market because I was not honest with myself about my mindset, about my capabilities as a trader, and about the circumstances of the market having changed. And a lot of people might be really surprised to hear that about me that I one of my most valuable lessons was losing six figures. It was an expensive lesson. I wish it had not been so much, but it was a valuable lesson nonetheless because it allowed me to train myself to be brutally honest about myself and to work through that that ignorance and that defensiveness that led me down that path and ultimately prevented me from losing far more in the market or worse giving up on the capability or the potential opportunities that arose from getting involved in it in the first place. So, in addition to that, I want to share a my personal experience with becoming brutally honest, and possibly this might explain some of my own behavior in social media and why I am the way that I am. I get comments all the time in social media of, why am I so abrasive and why am I such an why do I not care about people making mistakes? And it's not that I don't care, it's that I choose to be brutally honest about problems that are obvious to me as somebody with experience in life and in training. Because honestly, the stock market doesn't care, but I can. I'm capable of caring enough to tell you a hard truth about what's going on in the market. So I get a lot of flack from people on social media saying that I am, for one, a lot of people accuse me of being wrong. That's fine. I can admit that I'm wrong. And I often do admit when I'm wrong on a trade. And that doesn't bother me. I'm not scared of being wrong because I am capable of acknowledging when I've made a mistake and identify why that mistake happened and then correct it so that I don't make the same mistake twice. Or I'm able to easily identify when that same situation appears in another scenario later on. And I can prevent myself from making the wrong choice later. Another thing that tends to happen is a lot of people throw blame at me for making the wrong call. And this is where I see that defensiveness coming into people's mindset. And that's another mistake that happens. If you are in a position where you're trading in the market listening to what others are saying on social media without doing your own critical thinking and you're not paying attention to risk management and you're taking people at their word without analyzing what they have to say or analyzing the market for yourself and then you blame that person, you thrust all of your anger and your aggression at them for having disappointed you, you are not being honest with yourself. because that was your decision. And that's why I'm able to sustain that kind of flack, that kind of anger that's directed at me whenever a trade goes sideways and inevitably people get upset. This was hard for me to learn as somebody who is not just a trader, but somebody who was publicly disclosing what trades they were making. It's one of the most difficult things to do is to be able to sustain that kind of aggression and anger from other people who are taking what they think is advice. Nothing that I say is advice, and I know this. I'm sharing my thoughts, my analysis of data and market trends, and I like to think that I'm right most of the time, and that by doing that, I can help people. But also, having to accept that there will be people who are not brutally honest with themselves that will direct that brutality to me. And I'm okay with that. But to those people, I would warn them that choosing that route is ultimately failing yourself because ultimately it's your money and it's your decision. And you shouldn't place the responsibility of your money and your financial decisions on another person. It's your money, it's your life. That is nobody's responsibility but your own. And that is what brutal honesty requires, that you acknowledge that it is your fault. It is your responsibility for a trade going bad. Taking in bad advice or taking in a trade from somebody else, whether it's me or anybody else, and it goes wrong, it was your decision. And you have to be honest with yourself about it. If you can't, then you can't trade. And this extends to all facets of life, that your decisions, even if it is rooted in advice you've received from others, nobody can take the blame but you. Even good advice you take in should be analyzed and understand and accept at the moment that you make a decision and you commit to it that it is your choice. And it doesn't matter what information you took in, good or bad, the choice is yours. And it's your life that has to sustain the consequences. There's another element to it that goes in the opposite end of the spectrum, that people must also be brutally honest with themselves by adding the brutality to the way that they treat themselves. This is something called ruinous empathy. The idea that somebody can be too kind to themselves. This is excuse making. I made a bad trade. Why did I make the bad trade? Oh, it's the market. The market changed, or it's manipulation. These statements, these are excuses that people make in order to justify why the fault isn't theirs. And while there is manipulation that happens in the market, there are things that you must be capable of doing and recognizing as a trader in order to prevent yourself from becoming a victim of that. You can't just throw your hands up in the air and tell yourself that it's the market's fault. The market doesn't care. It's your money to risk, and it's up to you to manage that risk. If you're upset and throwing stuff at the wall because the market changed on you, it's up to you to be honest with yourself that you didn't see the change, or you didn't manage your risk, or you didn't exit properly. That kind of brutal honesty can do wonders for your capabilities as a trader. So the sooner that you adopt the mindset of being brutally honest of, I made that mistake, the market changed. Where were the signs? Ask yourself, where were the signs that the market turned? What changed? How could I have seen this coming? And then be honest with yourself about whether or not you can see those changes coming. Read books. Go get advice from other experienced traders. Watch podcasts. Educate yourself. Because if you live in ignorance because you are just too empathetic with yourself and you cast blame elsewhere, then you will never put in the effort to go and learn why things are not working out for you as a trader. And this can become even more toxic as you become even less honest with yourself and you stop caring. Eventually, you break down into total mistrust, and then you become the person that says, well, the market's corrupt and it's just going to take my money, so I'm just going to quit. And ultimately, that's the wrong attitude to have, because the market is it's the greatest investment vehicle in this capitalist society that we live in for creating financial change for yourself. There's honestly no better way to ensure financial freedom and independence for yourself than to get involved in the market. As I said, ultimately, every single trade, every single decision, every choice you make in life is your responsibility. And the best healthy way to make those decisions and to learn from each one of them is to be brutally honest about the outcome, about why it happened, how you're going to either fix it, correct it, adjust it, or improve it. Make sure that you are getting compounding returns with each decision you make. That is the difference between a weak trader versus a strong trader, and the difference between failure and success. It all comes down to your mindset. And I'll leave you with this quote by famous inventor Thomas Edison. When asked after his 1000th failure to create a working incandescent light bulb, the reporter asked him, "How did it feel to fail 1000 times?" And Edison answered, "I didn't fail 1000 times. I found 1000 ways not to make a light bulb." And that kind of attitude is what ultimately drove his success. Every failure is a learning experience that you can use as a tool and as fuel for your success in the future. With that being said, let's go ahead and do a quick recap on the day in the market and see where we are with the S&P 500. So, looking at the chart so far, today we had a big gap down and we closed the day ultimately above our yesterday's close. It was pretty much my expectation for how we were going to set up this Friday. So let's do some quick analysis. This is the giant flag that we saw in the market for uh, the past several days. We watched this form actually since about February the 1st. So we're into about 1 week after Friday where this flag had started forming. So far, we've had 2 touches on the top, we have had 2 touches on the bottom. So couple of possibilities. My first thought was with these lowering highs, specifically with resistance right here above us at about 415, 414 or so. My thinking is that the market is getting weaker, and this is pretty much in line with what I've discussed over the last couple of weeks, that we were getting close to a top. Now, for the near term, we may see one more push to the upside, which would put us for a third touch at the top of the bull flag. Now, that will be the critical point for the market to confirm a recovery. If it doesn't and it fails at this third test of the flag's upper channel, that is going to signal a big reversal to the downside. If we never break these highs, which is essentially a double top right here at 414, 414.50, then that's the resistance that will confirm a continuing downtrend. So that is I would say, the neutral case, or my slightly bullish case for the market next week. And this is because we did come back pretty strongly, and now we are testing the 50-period EMA on the 15-minute chart. So a lot of converging moving averages right here, and we have this cross down of the 50 and the 200. So if the market does break this 200 level right here at 409, then we can expect to see another test and rejection of 414 here at some point next week. However, if we get a rejection off of this level, then this would be confirmation that we are preparing to break down. A classic double top pattern indicates that when you hit your first top and then set up your support and then retest that resistance and fail, then the very following move to confirm a double top pattern is for there to be a failure at that initial support right here. So the market has to either break this level to invalidate the double top, or it will start heading further down. And that will be the critical moment, is when we start testing this 200 period EMA on the 15-minute chart. Will we continue to range in this area? Will we break this range and head back to the top of the bull flag, which is a very tradable range, by the way? If you see this breakout, then that's a very tradable range between 410 and 414. Or will we receive the rejection either at the 200 period EMA or at the support, which has now become resistance at the bottom or the M figure of the double top formation? So if we get either of these, there's a lot more bear cases for the market than there are bull cases. Going further out to the 1 hour, We can see that we're currently testing support at the 100 period EMA, and we did get a bounce, but we are at the 50 EMA, which is now acting as resistance for us on the 1 hour chart. So, a lot of resistances above us, especially with this double top formation inside of the bull flag. Going out to the daily chart, we can take a look at the overall prevailing trend of the market, and we can see that we still have this resistance, which we got rejected off of pretty cleanly right here. This resistance at 416, 417, thereabouts, was very clear resistance that I said if we don't break that level, then ultimately market's coming back down. Where I see the market going from here is I kind of expect us to form a head and shoulders by the time that we're done testing before we're done testing the outside of this megaphone pattern. So one of my possible scenarios is that we either bounce off of the top of this megaphone and get a little bit of a mini rally going before we run into rejection or run into resistance and get rejected somewhere in one of these three levels of resistance. So something like this. Or we break down into the megaphone and get rejected off of this resistance here and then head further down back into the megaphone. My reasons for speculating on this downturn is that the inflation monster is still not dead. A lot of people are banking on the drop of rate hikes or the slowdown of rate hikes from the Fed as a big bullish catalyst for why the market's going to recover. It's not the case. All they're doing is just taking their foot off of the brakes and letting the system kind of coast and see where the market heads and see how inflation reacts to it. By letting off the brakes, they're inviting an opportunity for inflation to come surging back into the system and creating another big jump in the CPI. So if that happens in immediate response to the lack of rate hikes, if we slow down too much, then essentially it's like, as the economist that I mentioned in yesterday's video said, that it's like stopping a antibiotic prescription in the middle of your course of treatment. If you stop too soon just because you start feeling better, then the the bacteria comes right back and it's even harder to kill the second time around. And that's what I fear that we're doing right now. So the inflation problem hasn't gone away. We're still at 6.5% inflation. And just to put that into perspective, this is the growth of our CPI just since 2021. This is where we're currently trading at, and this is how far inflation has taken us. Even if inflation went to zero, then we would be flatlining at this cost of living, and that's a massive margin of change. And that's a best case scenario. It's not possible. Obviously, inflation's not going to go away entirely. It's not. It's not even going to go down to 2% within the next year or two. The question is, can they slow down inflation enough for the consumer's income to catch up with the cost of living? And that takes time. We're going to be waiting probably for the next half decade to see the true effects of the inflation that we're experiencing now for it to have on the economy. Because ultimately, what this translates to is an invisible tax in a lot of ways. People are going to have an increased cost of their staple goods, the necessary things they need to live their lives. It's going to create a massive increase in the cost of living, which already we've been at a breaking point for the last 5 years. The cost of living was already nearly unbearable, and everybody has been joking from the millennial generation down to the Generation Z that buying a house is a pipe dream for boomers and we're never going to buy a house. Most people have cynically accepted that it's impossible for us to afford to live now. And that was back in 2019 before the pandemic hit and created this massive wave of inflation. So we are far from feeling the true long-term effects of this. This is like cancer in our economy that is going to slowly eat away at us, and it's going to create an even bigger gap between the wealthy elite and upper middle class and the middle and lower middle class. Moving on to the stock market heat map, the sector that performed the absolute best was energy and materials. And this is an inflation preparatory move. Whenever you see the energy sector get a whole bunch of money pushed into it all at the same time, and it's not tied to just one particular company, that means the expectation for oil prices to rise is is what is on everybody's mind in Wall Street. Everyone's expecting oil and gas prices to rise, energy materials sector to do well, and this is going to translate to an increase of cost of goods and cost of living for the average consumer. Essentially, it's an inflation hedge played out in the stock market rather than with metals or any kind of stable asset. So, seeing this being the only green sector on the day is a bit of a concern. And if you look on the week, you can see that this sector has been the greenest for the entire duration of the past week. By contrast, weekly, the tech services sector took massive hits. Apple came back a little bit in the electronic technology sector, but overall, nobody's really doing particularly well in the risk on tech sectors. Consumer durables are altogether massively red. Tesla is the only green company that you see in this sector right now because they were so badly oversold that their rebound had to be magnificent. And ultimately, a short squeeze got mixed into it. And of course, once again, shorts over leveraged themselves in Tesla and then got burned really badly when they announced a better than expected earnings. Ultimately, everything that concerns the consumer discretionary and consumer staples sector, the utilities sectors, everything that raises the cost of living for average Americans is going up. All of these companies are doing poorer, their costs are going up, expenses are rising, and we're all starting to feel the effects. The energy mineral sector is the only thing that's doing particularly well consistently on a month to month basis. Several ways that you can try to trade that is you can go long in the XLE index, but we are forming a bit of a flag and we're getting pretty close to the top. So you may want to hold off on that until you get some confirmation. This pennant structure that we have forming in the XLE index could result in a breakout at some point above this level, and we could see the XLE index rising. XOM, which is the largest ticker symbol on the energy minerals sector, is also performing extremely well. You can go and look at this ticker and you'll see that on the daily chart, it's been just ripping and roaring nonstop since 2022 began. Honestly, ExxonMobil is one of the biggest performers in the market right now. It's the one thing that's consistently green. You can probably expect a lot of the same performance out of Chevron oil as well as Phillips 66. The oil sector right now is going through a huge change right now where they're essentially bringing in more cash. A lot of these companies are pushing green initiatives and looking to get into green energy in order to kind of secure their future sustainability. And the market's been responding very positively to this as well. I'll end on the XLRE index, which has broken its 200 daily simple moving average, and now it rebounded to try to retest it and get back inside. So our first break of the 200 simple moving average occurred after this red candle closed down at $40. We've had this green bounce candle close just below it. We wicked through it and we got clear rejection off of the 200 EMA and the 200 daily SMA. These significant moving averages are signaling rejection for the housing and real estate sectors. This is the confirmation that I was waiting for. I'm already into my positions. I'm already going short on the XLRE index. And I think that a lot of members of Hell's Trading Floor have also followed in on this trade as well. But for everybody else who gets um, this information through YouTube, this is my official confirmation signal. XLRE just got rejected from its previous highs, and now it's rejected its 200 moving average. If it doesn't bounce first thing Monday and just soar straight through previous resistance and prove me horrendously wrong next week, then I see XLRE coming down all throughout spring, and we're going to see this market bleed badly before we get through to the end of April. And one last thing on the SPY before I leave you guys for the day, I did also want to point out that we do have a very clear bear flag that's formed here on the SPY. So, uh, very possible that we may get rejected right here where we're currently standing. This bear pennant that we have here on the SPY ETF is looking pretty gnarly. If you end up seeing a breakdown early next week where we see the SPY testing and breaking down below 407, then this is going to probably signal some continuation to the downside. Once we break the 405 level, then it's pretty much back to bear market territory from that point on. My worst bear case scenario is that we end up with a massive gap down straight below 405 and we head down throughout the week next week. The market conditions are starting to look even worse, and it was mentioned in the trading floor today. We saw a whole bunch of calls on the S&P being sold. There was a lot of call volume, and a lot of people took this as a bullish sign in the market. However, because they don't have access to our market data, they didn't realize that almost all of that call volume, more than 70% of the call volume this past 2 days on Thursday, Friday, was almost all bid side trades, meaning those calls were being sold. That's profit taking and selling covered calls in order to take profit from downside moves. So please, 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 please be careful if you are trading SPY to the long side. I'm really nervous about what's going to come early next week. If we do get that big surge early on next week, then again, your resistances are here at 410 or 14 and currently 409 in the very near term. So breaking 409, 410 first thing Monday and Tuesday is your goal as a bull. If you are a bear and you see rejection off of these levels, then that would be your entry signal to go short for the duration of the remainder of February. That's going to be it for this video. I want to thank you guys so much for watching, and think about what I said about trader mindset. Remember that you are responsible for your decisions. Practice that brutal honesty and work on getting yourself into a healthy mindset so that you can become the best, most successful trader you can possibly become. Thank you guys for watching. I look forward to seeing you in the next one, but until then, have a hell of a time in the markets. Thank you guys so much for tuning in to watch this video. If you enjoyed the content and you found this information helpful to you in your own trading strategies, be sure to leave a like on the video. It helps out the YouTube algorithm and helps us reach out to others who need this information too. Be sure to subscribe if you want to see more. And if you're not a member of Hell's Trading Floor already, consider joining our Discord by joining us at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.